Well, Lyft shares are plunging in early trading after issuing weak guidance in its latest report. Our Deirdre Bosa joins us now with more. Hey, Dee, on one hand, it's from a consumer standpoint, it seems like it's a pretty good thing in terms of the supply-demand situation beginning to even out a little bit here, but not so good for the company itself, and certainly today, not good for the stock.
I mean, it's good for the consumer if Lyft can continue to lower prices. But I guess there's the question, which I think some are asking this morning, how long is it going to be around to do so? It has ceded market share, kept talking about these competitive forces during last night's call. One analyst on the street called it a debacle for the ages. And it certainly felt that way as we saw the stock plunge right after earnings, 25%, then during the call, 30%. Now it is down 35% today. This is its worst day since the IPO. And it's at $10.50, guys. This is a stock that went public at $72 a share. So that really tells you how far it's come and how far it's fallen. But also what's really important here is this divide between Uber and Lyft. Since they began their lives as public companies, they would trade mostly in tandem. Over the last year or so, that relationship has completely fallen apart as the street sees Uber as pulling ahead. They used to value the pure play Lyft focus, but that has really been out of favor recently, especially as Uber is able to show investors that a diversification, its move into food delivery and advertising is going to lead to better adjusted EBITDA profitability. Speaking of profitability, guys, though, this is still an industry that is still highly unprofitable. Uber lost $9 billion in 2022. Lyft lost something around $1 billion. So a lot of questions here, including what is next for Lyft. Does a buyer swoop in here? Would anyone want it? Not so sure.
Yeah, Deirdre, that's what I was going to come back at you with, actually, M&A and who might. By the way, we should point out Uber is also still below its IPO price. I mean, you didn't want to own either one of these things. And Uber's IPO was a disaster, if we recall. But on the M&A front, is there any logical potential consolidating play here for these guys?
There's possibilities. Some names have been thrown around, but logical, I don't know. I mean, Uber would never be able to do it, nor would it really want to because it's pulling ahead in terms of market share. Now, there's the idea of a DoorDash. Maybe Tony Xu and his team could use the driver force, the driver contractors that Lyft has. But he's made clear in the past that he doesn't actually see very many benefits. People who drive for ride sharing don't necessarily come to food delivery. So that's unlikely. He's also kind of struggling to integrate the last acquisition they did, which brought them international. So why would they turn back domestically? It's a question maybe of Didi, maybe, or a Chinese ride-sharing company, or otherwise an Asian ride-sharing company. Would they want to come to the U.S.? Didi, unlikely in a position to do so because it's still trying to get out from Beijing's crackdown. Maybe self-driving car proposition here to pick up Lyft's network. But again, I come back to the losses. This is a company that lost about $1 billion last year. Who wants to take that on?